Welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what's likely to happen in the coming week. Now, this week it's been a pretty exciting week. We had a period where markets did nothing for 2 weeks, just went sideways. Then we had a bit of a dip. But then at the back end of last week, we had a scenario where the market started to push higher and change and reverse, gain a bit of momentum and actually reverse some bearish moves. What happened, if we look at the S&P 500, so if you're looking at your stock app on your phone, then go and type in GSPC. That gives you the S&P 500. Don't ask me why the codes are so ridiculous, but they are. You will look, if you go back and look, extend the time frame to a month, you will see that the market was bouncing along against that resistance level that I talked about, that zone between 2,800 and 2,825. Now, that zone was resistance and the market hit that, then fell away again. It keeps doing that. It's struggling to get above it. But at the end of last week, the market started to gain some momentum. Now, part of that was because of something called quadruple witching, which sounds incredibly bizarre, but 80/20 investor members will know all about that. In a sense, all you need to know is there's a lot of financial instruments that expire, options that mean that there's a lot of trading that goes on at the point of every quarter. Once every quarter, there's a lot of trading that goes on towards the end. And it's on that particular Friday, it fell. It's a bit of a witching hour for markets. And it means that lots of stuff goes on. And it tends to mean the market has a strong week. That's just historically if you go backwards. It's not guaranteed. So there was always going to be a slight upward push, a slight upward bias to last week, which is what we got. So as we rolled over into this week, we had the market setting up quite nicely in America to maybe push and break that barrier. And it eventually did. Now, we got up to about 2,850. Now, that is very bullish. If you look at the markets right now, anything above about 2,815 on the S&P 500 is a bullish sign. So it looked like we were finally going to push on towards 2,900 and all-time highs. And if you look at stock markets generally, where the US goes, the rest of the world tends to follow to a certain degree. So that was going to be very bullish. And so we have got an upward bias towards markets now. The bulls are being in full voice. The bears are slightly licking their wounds, but we are not out of the woods just yet, because we've got to be mindful that there is still some headwinds. Now, China and the US trade talks are always in the background. So we've had some slightly negative rhetoric around the US-China trade talks. So what happened is China is rumoured to be pushing back against some of the stuff that the US is actually asking or demanding in the trade talks. Now, that has been slightly negative, but we're getting loads of this. We're getting positive and negative news. In fact, not a lot seems to be going on at the moment, although there are signs there are going to be some new talks next week. What was interesting, the market pulled back slightly this week, but only to bounce back. We're definitely in a buy the dip kind of environment. It's how long that can last, but that shows some signs of strength. So on the downside, that 2,825 level has become resistance, and so down to 2,800. If we break below there, then you start to get a little bit worried, and then 2,700 below that. Now, I don't know why it is. It's a psychological thing. Humans like psychologically round numbers, 2,800, 2,700. Now, there are resistance levels all the way down through that, but keep an eye on that to the downside. Now, what could mess things up for the market right now? Now, today, the Federal Reserve is going to be announcing the latest interest rate decisions. We're going to get more from the Fed about what their view on the projection for interest rates are and monetary policy. That could shake up the market, because if you remember, the Fed is incredibly dovish. They're going to support this market. The Fed has got the markets back. If there's any crack in that, any sign that they're not doing that, then what will likely happen is we'll get a bit of a wobble in the market. And there's a lot of people wanting to sell this rally, not really believing in it. So we're not quite out of the woods just yet, but the market is still trying to break higher, but it hasn't burst higher. Now, if you look on the opposite side of the Atlantic in the UK, it's interesting because the FTSE 100 has jumped higher and it's actually broken above 7,250. That might not mean much, but what history tends to show, if we break above that, and we're above it to about 7,300 at the moment, we tend to very quickly head towards 7,500 as long as the momentum remains positive. So that's quite key. It's quite interesting to watch. Some of that is because the pound has been falling again because of the Brexit saga. That could equally go the other way, and partly because the price of oil has been rallying. We've seen a lot of strength in the price of oil this year, and it's helping to buoy the FTSE 100, because don't forget there's a lot of oil stocks in the FTSE 100. Now, if we look at the market generally, I mean, it's very bullish. There's a lot of positive signs which we're taking a lot of heart from. But there is something that reminds me very much of 2018. If you go back to 2018, the market ran away from itself in January, then sold off in February. There's a lot of signs, there's a lot of divergences. And by divergences, we mean where things that generally tend to track together or move in similar directions start to break. One of them is the 10-year Treasury yield and bond yields generally. Now, if you get your app out again on your iPhone, your stock app, put in TNX. Now, TNX will give you the 10-year Treasury yield. What's been happening is the yield has been continuing to drop. That is a sign of sort of nerves, reservation. And when the stock market tends to rally, the yield tends to go up because people are favouring risk assets like equities and not bonds. What we're seeing at the moment is the bond market is still remaining well bought. The yield is still remaining low. That tends to suggest that the bond market isn't buying what the equity market is selling. The euphoria, the sort of idea that everything's wonderful, economics are going to be brilliant, that growth is going to keep going. The bond market doesn't believe that. And the fundamentals suggest the bond market could have a point. Now, the other thing to bear in mind is that the VIX, the fear index, if you put VIX into your stock app, the VIX tends to mean it's an indicator of fear, and it tends to behave in a way that when stocks go up, the fear goes down, quite understandably, because everyone's feeling brilliant about things. What we're seeing at the moment in the last sort of couple of weeks, and certainly in the last few days, is the VIX is sometimes going up at the same time that stocks are going up. Now, that is strange, and where we've had periods like that in the past, it doesn't necessarily automatically mean we're going to get some huge change, but it can be a suggestion there's something worrying underneath that everybody's sort of overlooking, or equity investors are overlooking. So the upshot is that the market is very bullish at the moment. We've still got the trade war worries, and the Fed is getting to the sort of full extent of what its words can do. We've got to start seeing it do something very real, like maybe QE4, but if it does that and hits that panic button, then that could unsettle things altogether as well. Now, as investors, we're going to be keen on what central banks are going to keep doing, because that's what's driving markets at the moment. But as UK investors, it still matters what the pound is doing, because whether the markets abroad go up or down, then the pound will impact what you actually see in the terms of performance, as I've explained before, and when the currency conversion happens in your portfolio. With Brexit all over the place, then the pound's volatility is all over the place, so your portfolio will have elements of that. Taking big bets or making big bets either way, or what's going to happen on Brexit, could prove costly and actually unpredictable. And don't forget, the pound strength influences even things in the UK, such as the FTSE 100. So that is it for this week. If you've got any questions, do send them in to Damien@moneytothemasses.com. Share this podcast to your friends and family. Don't forget, you can get in touch with me on Twitter @moneytothemasses with the number 2. So until next week.